Hey everybody, it is Jack Weixler here with the monthly East Daily Production Stream webinar. It is December, and so we are shutting down 2025, and a lot of fun things have happened this year. Not excluding the debut of this webinar series. Lots of fun things in the market have happened as well. So, um, with me today, a host of energy experts. So I have Jackson Fryer, who's our head equity analyst. Jackson, say hi.
Hey, Jack. Hi, everybody.
Julian Renton, who leads our NGL team.
Jack.
And then we have Keelan Rumsey, who is our head oil analyst.
Hey there.
Oren Pilant, who is our head gas analyst, along with Ian Hemming, not pictured because we ran out of room on the slide. But yeah, both Oren and Ian are here for your gas concerns. So say hi, guys.
All right.
And then last but certainly not least, our upstream guru herself, back fresh from a vacation and other exploits, Maria Urdaneta. Say hi.
Hi, Jack.
Thank you. Very good. All right. So the program today, is going to kind of be a little bit like last month, although we have some revisions and some updates to talk about. First of all, a little blurb on what we do. We go from basically wellhead to demand and understand kind of how these molecules, these fossil fuel commodity molecules, basically how they get to their end destination, whether that's crude, gas, or liquids. We do not forecast in a vacuum. All of this material comes out of the same hole, and so thus, the rate at which one is growing impacts the other. So that's what we're gonna obviously, talk about those production rates this year. So we'll look at some trends exiting 25 and beginning 26. We're going to talk very specifically about the Haynesville because it's been a little bit of a roller coaster lately. We'll talk about gas storage and gas prices, how that's going to look at as we begin 2026. We'll look at key transactions kind of across the midstream sphere, right? I know Jackson's got some good stuff to add. Julian's got a pretty critical NGL project to talk about as well. And then we're going to talk more generally about crude infrastructure, right? So some surprising things, some things that surprised me there as well. And then lastly, we're going to check in with ourselves before we wreck ourselves. Maria's going to, maybe talk about some production trends at the end. But let's get into it. All right, Maria. What do we got going on here to kind of take us out of 2025?
Okay, so I think overall drilling efficiencies are becoming a key driver as part of 2025 and then 2026 outlook. While prices continue to affect decision making across both public and private operators, the impact on total production is far smaller than what we have seen in historical events of price volatility. For crude oil, we project that we will finish the year with an average of 13.7 million barrels per day. And then key basins here continue to be Texas basins like the Permian, Eagle Ford. And then on nat gas, we have dry gas production expect to average 107 BCF per day in 2026. And not a surprise, the Permian, Northeast, and Arc-La-Tex will continue to be the source of growth on the upcoming year. And then NGL's production is forecast to average 7.4 million barrels per day. And then the Northeast and Permian continue to account for most of the output fluctuations, reflecting both local processing capacities and takeaway dynamics.
And I believe those are record levels for all three commodities, right?
Yep.
So we just keep on keeping on. For next year, just a little bit of preview, right? We are expecting basically flat crude, right? And then steady increase in gas, about 4% gain there. So, and then about 2.5% gains in the liquid side of things. Okay. All right, well, onward and upward, I guess, with just general production trends. So that's great. Thank you, Maria. All right, now let's get into the guts a little bit here, right? So basin winners, losers. I like to say that like there aren't really any basin losers. They're just not winners yet, right? So here's what we're looking at for 26. There's a little bit of a disparity here, right? So production gains in the Haynesville, average on average about 1.7 BCF a day, while the Permian, that gas production is slowing a little bit. Naturally, as you don't have you have a less supportive oil price, your gas gains are going to maybe pump the brakes a little bit. But Haynesville is really important. It's really important to basically supply, growing LNG, that sort of thing. And so exit to exit, we have that at just under 3 BCF a day. However, that's different than last month. Oren, what is going on in the Haynesville?
Yeah, so just some background on methodology here. In Louisiana in particular, we are benchmarking against the EIA reported gross gas number. And so we've actually seen some pretty interesting fluctuations come in on that data where, kind of month over month, you're seeing, 800 MMCF a day swings in Louisiana production data. I think generally you can interpret that data as the Haynesville is already sort of balancing the market, in terms of that sort of incremental demand volume. And I think what that means going forward is that you could actually see some of that 2.9 BCF a day, 25 to 26 exit come in a little bit early where, maybe December production out of the Haynesville is a little bit higher and it kind of bumps up that 25 exit, pushing in, and then a little bit less in 2026. Keeping an eye on rig counts. Rig counts are ticking up towards, right around 56 right now. We expect the year to exit 58, but the main thing to keep an eye on or to understand in particular as far as that rig count number is, through most of this year, we've been consistently drilling above maintenance level production. And so what that tells us is that there is some sizable deferred production inventory that allows for those, swings on the order of a BCF a day, which, can be surprising, but should help alleviate some of the imbalances that we expect to see heading into 2026.
Okay. Yeah, I mean, just wild, right? So at one point, I think it was July and August and September production was above 109,
yes,
according to EIA, but then they scaled that back.
This month, 108.8 now. So, yeah.
Okay, yeah. So I mean, if there ever was evidence that Haynesville is the marginal molecule, that is it.
Yes.
Right? Cool. All right. Let's flip over to demand. Wow, look at that. Another waterfall graph, right? So, I think what we mentioned in this space before is that, with all the attention being paid to data center demand, right? At least from a gas perspective, it's really kind of playing second fiddle to LNG. And that LNG piece of the puzzle is really coming in view. 18.8 BCF a day of FID demand. No changes really this month. We were expecting perhaps to hear from Commonwealth this quarter about their pending FID, but they're still about 0.3 BCF a day away. So that may get pushed to Q1 26. Texas LNG Brownsville is about a half a million metric ton per annum commitment away from their own FID. But they're fairly confident that'll be Q1 26. So I think those will be the next dominoes to fall, pushing us well over 20 BCF a day of FID commitments. Design capacity there, feed gas capacity by 2030. Now, short term, and I'm gonna pick on Ian here, right? Roughly 3.7 BCF a day increase average on average for LNG demand in 2026, but only 0.5 BCF a day roughly in power. Can you tell me upside or downside risks to those figures there, Ian?
Well, there's always going to be risks associated with LNG. We know that Golden Pass is really expected to start up, but they've had a lot of issues that could easily push them a little bit further back. We've kind of seen also when some of these newer companies are starting up and going through commissioning, it doesn't move quite as quickly as the more mature developers such as Cheniere facilities.
Mm-hmm.
And so those are kind of your bigger risks on that one, but it's the data center side is really where this gets very interesting, because while we are finally starting to really see that increase in demand, it's very difficult to predict how much exactly is going to be coming online at any given point in time. This stuff tends to be very small incremental gains for the most part, and those facilities that we would expect to see much larger changes from are typically weighted towards the back end of the decade, if not moving into 2030. So it's very difficult to say at this point in time how much we're really going to see, and that creates a lot of uncertainty in that demand profile.
Mm-hmm. Yeah, if you look at our macro S&D report, there's a lot of numbers that are thrown around. I think, in my mind, 0.5 BCF a day of power burn gain, kind of weather neutral, right, is probably about right. That's the medium temperature bowl of porridge right there. For our three bears. So okay, well, great. That's a healthy demand jump there for 2026, and that's what's going to be driving the market. So flipping back to the Haynesville, right? Here's an interesting chart, which I know we've shown before, but I think it needs to be re-emphasized, right? You hold rig count in Haynesville at 50, and you're going to get $7 to $9 to even $10 gas because of the deficit that it basically creates, right? However, if you kind of follow our path there, the balanced trajectory path, you're still going to be in deficit territory. In fact, you're nearly slipping below 100 BCF where we are kind of currently, right? And so, we saw prices bounce up, cash prices and the curves bounce up closer to $5 last week. We had a little bit of relief since then. But I think the point is that if you don't drill 65 plus rigs in the Haynesville in 2026, then you're on a road to Troubleville, for lack of a better word, just in terms of price is concerned. So that's that. If we look here and just take a look at our price outlook, right? In those yellow colored areas are the period of time where we see the most, kind of consistent period of time where we are in so-called Troubleville, right? Like down below in deficit territory. So I'll let you all read the notes there on the side. But basically, there's still some opportunity here, to capture value. Pay attention to those out month prices, particularly as we get into Q1 26, just to see where they're behaving, because our forecast is, kind of unapologetically bullish as we continue to see the formation of large deficits. Certainly, by the end of January, we could very well be there. So keep on paying attention to that. All right, so let's flip over to the kind of the transaction side of the market here, and we got a couple of NGL projects out there. Who wants to talk about this bad boy here?
Yeah, I'll take it away, Jack. So this story came out of ET's 3Q25 earnings call. Really interesting. So Energy Transfer is evaluating converting a Permian NGL trunk line to natural gas service. Like, this timing makes sense, right? With Permian gas demand, like you're saying, Jack, and takeaway needs accelerating, while we expect Permian Y-grade takeaway to trend increasingly long as new pipelines to Mont Belvieu ramp up, right? On their call, management even framed it very bluntly and said, in today's environment, converting the candidate line could roughly double our revenue in gas versus NGL service. So given the weak NGL rates and stronger gas demand with the overbuild coming out of the Permian, so ET hasn't said which pipe it's considering, but in our view, the best one is West Texas Gateway, or WTG is most plausible conversion candidate. WTG is a 16-inch NGL pipeline, roughly 570 miles, moving about 209,000 barrels a day. It's been in service since 2012, but it's a key nuance here is converting a NGL pipe from liquid to gas conversion is not the simple flip of a switch. So we consulted with our pipeline engineer to dig a little deeper, and WTG was built under hazardous liquids regulations. So if you convert it to gas, you shift it under natural gas pipeline rules, which generally means a lot tighter constraints. So you can reuse the steel, but you still have meaningful engineering compliance to handle. From a capacity standpoint, we're estimating about 0.1 to 0.2 BCF a day of gas coming out of WTG, with a EBITDA estimate from the team of about $20 to $30 million per year. And then the challenge is CapEx. A realistic conversion could run $200 to $400 million, which puts a payback in
like
an
10-year
to 15-year range, right? Yeah.
Yep.
So the other candidate with the best economics is the 30-inch NGL line Lone Star, which by far has the best economics. And we estimate it can move 0.8 to 1 BCF of gas per day, which supports about $120 to $180 million of EBITDA and puts the conversion CapEx in that $250 to $400 million range, right? Much faster payback with 3 to 5 years. But again, this is a core NGL artery feeding ET's Mont Belvieu complex. So our take is Lone Star looks the best on paper, but the business trade-off is much bigger, while WTG is more plausible to repurpose.
Interesting. And a 16-inch line, so that's why it's so small, like on the gas capacity side. Would you entertain expanding that pipe in the trench, or is that just makes your payback period longer, right?
Yeah, they might do an expansion project. I was analyzing just based off of they said they're going to convert it. So what would that conversion look like, and what are the two possible really candidates that they could use? So yeah, just using a straight up conversion with compression, that's what it would look like. But yeah, they might want to expand it.
Gotcha. It's nice having a pipeline engineer on staff, right?
Yes.
Especially when they're doing market, dynamics and also, customer stuff. So, all right. Well, I mean, that's super interesting. So basically, getting gas out of anywhere is a hard enough thing. So just throw as much steel as you can get at it. All right. Julian, you have another NGL project here to talk about, or at least some investment here, but they want to keep this line full of liquids, right?
Yes, they certainly want to fill this line, and this is kind of adding on to what Jackson was saying. Really, we want to come at this from, it's been very interesting, the developments and kind of difference in strategy that has, I think, kind of developed recently between Enterprise, Targa, and Energy Transfer. So I want to direct kind of your attention to this chart. This is a comparison of the 6 large NGL players in the Permian. EPD, ET, and Targa, we call them the big 3. They're kind of the entrenched players. PSX, ONEOK, and MPLX, those are kind of the rising 3, in our view, have less infrastructure, but definitely playing for the game. And, this deal is interesting because Exxon has taken a large stake behind Enterprise. This is meaningful for Energy Transfer specifically because Exxon is around 18% of their processed gas volumes. So I think over time, you might start to see those discretionary barrels, NGL barrels, slowly shift from ET's system towards Enterprise's system, kind of incentivizing in a way that conversion to gas, like Jackson was talking about. And it's kind of, it's kind of showed the different strategies where Enterprise and Targa have both announced new NGL takeaway pipes out of the Permian. Targa announcing Speedway, and EPD announcing the Bahia expansion, not just the Exxon deal. So to me, that's kind of, 2 different type of players. You have Enterprise and Targa really aggressively buying and building into an already overbuilt market. They certainly seem to think that capturing the barrel is going to be now or never, right? And when you look at the NGL value chain, from GMP to your pipe transportation to frac to exports, you have a lot of way to make money. So it might be kind of their strategies. You can lose some money on the pipeline rates, especially with all the pressure you're seeing. Lose money in the pipeline rates, but you make back your money, fractionation, storage, and exports. Energy transfer, I think, is taking a more risk restraint strategy. They're not necessarily building into an overbuild, and they're even considering optimizing their assets to gas. I think it's yet to be seen exactly which strategy is going to win at the end of the cycle, but it's kind of interesting to see two strategies. And then for Phillips, ONEOK, and MPLX, it kind of a lot depends on what Enterprise and Targa are doing. If Enterprise and Targa do manage to capture the marginal barrel, ONEOK and MPLX with their Texas City JV export dock in 2028, it could be coming on at a bad time where the NGL barrel is already accounted for. It's just going to kind of heighten the competition. But if it kind of plays out more in Energy Transfer's favor, it's kind of more strategic, and maybe Enterprise and Targa did overcommit into building new pipes, ONEOK and MPLX could benefit from kind of the late movers advantage there.
So that export dock, that's a JV between ONEOK and MPLX, right?
Yep.
It'll give them kind of a pathway to the water, which we know is an important component here, because otherwise you're reliant and you're paying a fee more than likely to one of those big three, correct?
Yep.
Okay. All right. Well, this is interesting. I don't know that I've seen it kind of broken down like this before. And for those that only dip their toes in NGL markets, it's good to know who you're dealing with, right? So this is kind of like the McDonald's, Taco Bell, Pizza Hut of the Permian here. And then you got maybe like Wendy's and a couple other upstarts are trying to get in and dominate or take a piece of that market. So, all right. Well, Julian, any kind of closing thoughts on this, or do you think? I think we hashed it out pretty good.
Yeah, I think we hashed it out pretty good. And I mean, I think just to how we were saying, the wellhead to water strategy, if you look at the chart, ONEOK and MPLX are the only ones that don't have the final piece. That's something they're looking to solve together. So for them, really what happens between EPD, ETM, Targa is going to determine a lot for them for their future.
Cool. All right. Well, very good. Flip over. Jackson, you got one more, or is this a Julian too? Okay. Jackson's go. So we got a takeover. Targa buying stakeholder Midstream. Why did they do this?
Yeah, well, first I want to touch on like what Julian's saying here, right? There's those two strategies of build and buy or rent of that NGL capacity or just the barrels themselves. So it's been a really interesting month for Targa, right? With the stakeholder, like you're seeing here, and the dovetail deals looking very consistent with their wellhead to water strategy behind the Speedway NGL pipeline announcement in October. So at a high level, this is about that broader race to secure the Permian NGL barrels and keep them captive on Targa's system all the way to the water. So starting with stakeholder, Targa's paying about $1.25 billion, or roughly a 6x on the 2026 unlevered free cash flow, to expand its operated footprint in the Permian. Stakeholder adds about 460 miles of gathering and 180 million cubic feet a day of processing, and the plants are only running around 60% utilization. So that gives Targa potential operating leverage in the future here. Importantly, the deal comes with dedicated acreage and fee-based contracts, meaning more wet gas should flow into the Targa plants and onto Targa NGL pipes, rather than landing on a competitor's system. So then the dovetail deal, the acquisition from Riley Permian does something similar in Eddy County, New Mexico, as it's a bolt-on gas gathering system tied to a growing upstream position. Zooming out though, right, like Julian had it in the slide before, Targa moves roughly 1 million barrels of NGLs on its existing system already, and it's in the middle of a major build-out with 5 new Permian gas plants, plus the 500,000 barrel a day Speedway pipeline, which is expandable up to 1 million barrels a day, targeting a startup date in 2027. Right? There's 2 ways to read into this buying spree. Right? Targa's seen as the leader, typically within this NGL overbuild or race in the NGL strategy. And the truth is probably a mix of these 2 ways you could read into it. So on the offense side, Targa's leaning into Permian gas and NGL growth and positioning itself to eventually justify expanding Speedway towards 1 million barrels a day. However, on the defense, these deals do de-risk utilization, and they're locking in dedicated fee-based volumes so Speedway doesn't start life underfilled, which matters in what could be a vastly overbuilt Permian NGL takeaway market.
Hmm.
So net takeaway plus dovetail strengthens Targa's wellhead to water footprint and improves confidence in future throughput for new plants and Speedway.
Okay. That's pretty tight analysis. So I guess just generally speaking, right, for these were some of the big year-end deals that we've been monitoring, right? Just real briefly, Jackson, do you expect more of this to occur in 2026?
Yeah, it's going to be interesting to see how it unfolds. There's still a couple small, as far as the GMP side, small systems that are available. We'll see what they go for on as far as multiple side and expectations, right? The MPLX Northwind one was, I think a 6x, but on what they expected their 2026 free cash flow to be on, which is much higher than it currently was. So we'll see how those unfold, as there's only a few pieces left.
Okay, so more empire building to come. Very good. All right, let's flip over to crude here with Keelan to kind of close out. We were on the road last week in wonderful sunny Calgary, Alberta. And we brought this up with a few of our clients. I was surprised to hear about what's going on from a crude infrastructure perspective. So Keelan, can you please alliterate?
Yeah, thank you, Jack. So I kind of put together some slides, some highlighting some of those planned expansions we're seeing in the Permian. And then I also have a slide kind of comparing and contrasting against what we're seeing from the Canadian infrastructure. Some of the things I wanted to flag that are coming up in the Permian, you're going to see that Gray Oak Phase 2 expansion at 40,000 barrels a day of capacity. That's going to be coming online of April of 2026. That Midland to Echo 2, that's a pipeline to kind of watch. That's transitioning over from NGL service into crude. That's going to add 200,000 barrels a day of capacity. And then a potential expansion we see maybe happening is Plains recently bought 100% of that EPIC pipeline. And we could see that maybe expand up to 900,000 barrels a day. However, if they do that before the year of 2027, they're going to have to pay out Kinetic $193 million, I believe. And so we're not really going to see any of that expansion kind of happen until after 2027. And that's contingent on Corpus Christi route kind of staying heavily constrained. So overall, you're not seeing a whole lot of movement as far as infrastructure in the Permian right now.
Yeah, it looks like you've got, the 240. I mean, that's what, sub 10%, sub 5% of liquids production there, which is crazy. All right, so sorry to cut you off there, but contrast that to what is going on in the Great White North.
So what we're seeing out in Canada is certainly a lot more movement. Enbridge is certainly making some moves. In their recent Q3 reporting, we saw that they recently FID'd that Southern Illinois connector. That's going to add 100,000 barrels a day of capacity. That's going to connect Wood River into Patoka. Another expansion you're going to see is that Express Platte line. That's adding 30,000 barrels a day of capacity. And then Enbridge also announced that mainline optimization phase 1. That's going to add 150,000 barrels a day of capacity onto that mainline system, as well as adding 100,000 barrels of capacity onto that Flanagan South, which will eventually connect to Seaway and kind of bring all that Canadian crude down to the Gulf Coast. And some potential expansions kind of coming up that we might see come into fruition in the coming years. You have TMX that's potentially going to add 200,000 barrels a day of capacity. That one we view as maybe moving a little slower as far as till when we see an FID maybe come out about that one. Another interesting one is that mainline optimization phase 2. That's going to add 250,000 barrels of Canadian crude onto DAPL. It'll certainly be interesting to see how Enbridge and ET kind of plan on doing that. The way I see it is Enbridge right now has that Enbridge Bakken line going out of the Bakken up north into Canada. It wouldn't be the first time they reverse that line, but I see it as they reverse that line and kind of build out some of that infrastructure to connect it into DAPL, which of course will require DAPL to then kind of batch that pipeline as well.
Right.
But certainly a lot more movement kind of happening with WCSB.
I'll say, so that's almost 500,000 barrel a day of kind of near-term planned expansions, and then potentially another 450 there going out into kind of like the later period. So, dang. All right. That's a lot of action. And that is what we are looking forward to in 2026 is more action, more midstream infrastructure action, and certainly see how we pace ourselves with demand on the gas side of things. So production trends and totals, you all will get a copy of this presentation, so don't stress if I'm going too fast here. And then as usual, right, sign up for our daily and weekly content. If you like what you see, just become a customer. It's just that easy, you know. We don't ask for much, so but we are going to be asking you to, come on in and come home and spend some money with us in 2026 because we've got some great things going on. The next webinar will cover dirty little secrets for 2026, which is an annual publication. If we didn't talk enough about our expectations in 2026 in this webinar, we will certainly be talking about them quite a bit next month. So look for us in a town near you. We'll be in Houston in January. We'll be talking about our expectations for the year, and we're very, very excited. So thanks everybody on the call, and can't wait to talk to you guys again here soon in about a month.
Thanks, Jack.
Thank you.
All right, bye everyone.